All right, what's up, traders? Welcome to the official Trade Talk channel, where I show you how I analyze price for the most consistent and higher probable entries to help you guys become better traders. Today's session, we are going to go over the very basics of options trading. All right, we're going to go over some words and terms and stuff, and I'll show you a little bit about what's going on over there. So let's pull up Tastyworks. Let's go to the trade tab and let's get rid of that. So this is everything right here. All right. So we're looking at Apple as the stock. All right. But we don't care about the stock. We don't want to own the stock. We don't want to buy the stock. We don't want to sell the stock. We don't want to short stock. We don't care about the stock. All right. When you're trading in options, you do not care about the stock. All right. So why trade options? First and foremost, options give you the ability to manage your risk. All right. If you're long a stock, you can buy puts as insurance. As you know, if the price goes down with the amount of shares that you own, obviously you'll lose money. Whereas if you buy the put option, then that kind of helps you save money, because as the stock price goes down, the put will increase in value. But first and foremost, we got to go over the very, very basics. All right, so for now, we're going to stick to the call side. That's right. The call side will be on the left. The put side will be on the right. We're going to go out in time to what time? August the 25th, 2023. That's 34 days to expiration. All right. What's expiration? Expiration is the amount of time that you have before your calls or puts go to zero. Let me say that one more time. Your expiration is the amount of time before your long options, if you own a call or own a put, if it is not in the money at the time of expiration, that call or put will expire worthless. Okay? Worthless. So let's go ahead and open up this this expiration, and let's go talk about calls. All right, so calls on this side, puts on this side. All right. So first and foremost, we're going to talk about calls. What is a call option? Okay, the buyer, holder of a call option, pays a premium for the right, but not the obligation, to buy a stock at the strike price prior to expiration. All right, so there's a lot in that sentence, isn't there? The buyer or holder of a call option pays a premium for the right, but not the obligation, to buy a stock at the strike price prior to expiration. So we have already discussed expiration. All right, so let's discuss premium. All right, what is the premium? Well, the premiums are going to be this. This is your premiums right there. So there's the bid, there's the ask. All right. Whenever you're on the ask, you are a buyer. Whenever you are on the bid, you are a seller. All right. That's just the way it works. So you are a buyer on the ask, you are a seller on the bid. That doesn't matter if it's puts or calls, stocks, futures, or anything, right? Bitcoin, even, anything. Everything has a bid-ask spread. And in options, as you can see, the bid-ask spread on Apple, well, the market's not open right now, so these are not the correct quotes. They're not the correct prices, but they're going to work just fine for these examples that we're going to learn today. All right, so you can see there's a 4-cent wide spread on that. If you buy it at 120 and then instantly sell it, you will take a loss of what? 4 cents. All right. In that sentence, it said the buyer, which is the long strategy, right? Anytime you hear anybody say long option strategies, they mean they bought premium. So the premium is the price quoted here. All right. This is out of the money. On the call side, on the put side, it is in the money. You can see in the money, ITM. ITM stands for in the money. In the money. OTM stands for out of the money. So all of this is out of the money. Even to here, this is all out of the money. So if you buy the 225 strike, and if this price, Apple, the last was $1.9194. So if you get to expiration and you have the 225 strike, then that means your option, whatever you paid for it, the premium is what you're paying for, will be worthless. So this is the premium right there. All right. This is for buying long option strategies. All right. So premium is the amount of money that you have to pay in order to buy the strike. Right? What is a strike? This is the strikes right here. That's your strikes. It's actually price. All right? It's actually price. So when you're buying a strike, this is the price at which you expect the stock to go, given the expiration, given how many days there are to expiration. All right, so right here you can see that there's an IV. IV stands for implied volatility of 25%. So what they're saying, what the options market is saying, remember, these aren't real quotes. During Monday's open, these might be different. It might be 23% implied volatility. It might be $11 expected move. But anyways, the implied volatility usually calculates the expected move. So what this is all saying, right, is before the 34 days are up, they expect, the options market expects Apple to move $9. All right, that's the expected move. All right, I know we're getting off topic a little bit here, but you know, premium, I think you understand what that is. So we're kind of moving on. I don't have a script, okay? I did, and it got deleted. So we're just gonna do this right from the hip. We're gonna shoot from the hip. This is your premium. You're always a buyer on the ask. You're always a seller on the bid. So if you buy something at this price, you want this price to gain in value. And the only way that this is going to gain in value is if the stock does what? If it goes to 220 before 34 days. All right? Before that, you want the stock to be at 220. And right now, it's trading at 191. And the expected move is $9 for this amount of time. $9. So let's pull up the old trusty charts. So we got this. Let's get rid of all of that. All right, so here's Apple, right? We can see that Apple closed at 191.97 on Friday. This is August the 23rd. If we go back to tastytrade, you're going to see that we're on the August the 25th strike. So what I typically do if I am purchasing a position or selling a position, I go out in time and I put a green line 2 days before expiration. All right. The reason for that is because you don't want to hold anything to expiration. And we'll get into that a little bit later. You actually want to get out before the expiration date. Now, you can day trade options. All right. As long as you buy close to the money and, you know, you think stock's going to go up. If that's the case, you can buy it for $4.20 to buy the 195 strike. So if the 195 strike gets hit, or if price goes up to 195, this option premium will increase in value. And then you can sell it for whatever the bid is. All right. You will always be selling on the bid. Just like with my technical analysis, I teach you that you are always a buyer under price and you're always a seller above price. No matter your position, no matter what, right? Because the object is to buy low, sell high. Well, it's the same thing with this. It's no different than if you would have went out and bought 100 shares of Apple. You would want price to go up, you know, to 195. That way you can make what? $4. We're rounding it off here because you're at 192. All right, so if it goes up to 195, you make $3. And then you can sell your 100 shares on the bid. All right, you can sell your 100 shares on the bid and you will make $3 on the trade. It's the exact same logic in options when you're buying them, okay? When you're buying options in the call side, we're not on the puts yet, but when you're buying them, you want the stock to go to whichever strike price you buy. So, since we know that there is a $9 expected move on this expiration, all we have to do is simply go back to the chart, and we have to count $9. So we're trading at round off 192. $9 would be what? 201. So let's pull this down to 201-ish. Doesn't have to be perfect. And then also, because the expected move is up or down, right? Its expected move is $9. It's not a directional bias. It means that with this implied volatility, the options market expects this stock to move up $9 or down $9. It doesn't have to do it, right? But that's what the options market is pricing it in. So back to the chart. Here we are. We want to go $9 down from 192, which would be 183. All right, perfect. We can add, yay. All right, so this is the strikes that the options market expects the stock to do. They expect the stock to either go up, you know what, that's pretty ugly, or they expect the stock to go down, right? Anything outside of that is called outside the expected move, or a breach of the expected move. What's the expected move? One more time. The expected move is what the options market with the implied volatility expects the market to do. So if we buy a call, we know that price can go as far as 201 to the upside. And since we're sticking with calls, we're gonna only focus on this. So we know that the options market has priced in that there is potential for the stock to move up in 34 days, up $9, and that puts you at $201. So if you were going to buy a call, what strike would you buy, right? What strike would you buy? Would you buy the 250s because it's cheap, 7 cents? That means you can buy it for $7. Yeah, I mean, you can, but what's the percentage chance, do you think, that the stock is going to close at 250 in 34 days? Well, I'll tell you the percentage chance. Let's get rid of deltas and let's pull the probability of in the money. In the money percentages chances. So you will never have more than a 50% chance when you just go long an option. Never, ever, ever will you have that. All right? The in the money probabilities. Okay? You will never, this is the out of the money. This is the strike, or at the money, right? At the money is the strike prior to going in the money. So right now, the at the money option is 190 for the puts. The at the money option is 195 for the calls. You will only ever have a 50% chance of being right on direction. This is another reason why we trade options, because we can up those odds. How? Well, we'll get into how when we start doing strategy videos. Now, we're still only on the call buy side. Remember, as the buyer or holder of a call option, you pay a premium for the right, but not the obligation. You have the right, but you're not obligated to buy a stock at the strike price prior to expiration. So basically, say you're going to be long options and you're going to buy the $200 strike and you're going to pay a premium, which is $249. And option contracts are 100 shares. So one contract equals 100 shares of stock. 2 contracts equals 200 shares of stock. You get me? So that would be a $249 purchase. All right? So you purchase it, you pay the premium for the right to sell the stock at $200. That's what you're paying for. You're paying for the right to sell the stock at $200. Now, obviously, the stock has to be above $200 in order for this call option to make any money. All right, you got to be in the money plus $2.49 to break even on the trade. So what do I mean? I mean, you would need the stock to go up to $202.49 just to break even. That is, the rules. Now, obviously, things can happen, which we will get into later on, that can affect the pricing of your option. But if we're looking at this and talking about this only, this is it. In order for you to make money, you need the stock to be trading at least $203. That's just the way it works. We are buying the 200 strike. That is right here. So price would literally need to trade up to $202 for you to make money before this green line, because this is expiration. If your stock is, say, trading right here at expiration, will you make money? The answer to that question is no. Your stock or your option will expire worthless if not in the money. Okay? There's a time value associated with how options are priced. There is the implied volatility also is worked in the pricing of a stock. But in order for your strike to make money, you got to be in that strike, whatever strike you purchased, it has to be in the money. All right. That way you can sell it for a profit. Now, that's on the buy side, right? So if you bought that strike, you would pay that premium, and that is your risk, right? How much money am I risking on this trade, Heath? If I buy the 200 strike, if I buy the $200 strike, how much am I risking on the trade? Well, that depends on how many contracts you buy. If you buy one contract, you're going to lose $249. If you buy two contracts, then you're going to lose double that, and so on and so forth. So that is how you manage your risk when trading with options. When you're long options, the premium that you purchased is the risk. That is the risk. But the amount of money that you can make to the upside is infinite. So let's say we buy the $200 strike and we paid $249 for it. So we need the stock to get above $200 in order for us to even break even, right? So 202-ish to break even on the trade. So back to the charts we go. So here we are. What if the stock goes to, say, something happens, like good news comes out? Apple is now the best company in the world to buy based on this new AI thing they built. And Apple's stock price goes up to 216. Wow, right? What does that mean? It gives you the right to buy the stock at $200. So if Apple is trading at $215, what does that mean? Well, as long as it happens before expiration, that means you have the right to buy the stock at $200 because you paid the premium for the strike, the 200 strike. So that means you would have an intrinsic value of $15. This would be in the money by $15. And so you bought the 200 strike, price goes up to 215. So basically that means you'll be in the money. You'll roughly be in this area right here, right? So you can see the tremendous amount of upside potential that options have. If you buy the stock or the strike at $200, you paid $249 for it. That means you could make roughly in there. If, like I said, the strike goes way up to like 215, that means your strike will have $15 worth of intrinsic value. Intrinsic value, that means that you would literally be in the money somewhere in here. So anyways, you would have an intrinsic value of $15. So what is an intrinsic value? Well, intrinsic value is anything that is in the money, right? So here is a 190 strike. Since the price is at 191, that means this has intrinsic value because it's in the money. All right. So intrinsic value is when you are in the money. Your option becomes worth the intrinsic value of being within the money. Almost a $15 gain on that $200 put. Call. If you bought the $200 call and price spiked up, that means you would be able to potentially sell that option for whatever the bid is, right? You could try to get it halfway in the midpoint, but I wouldn't get cute as you paid $249 for it. You're now selling it for $1365. That means literally $249 got transformed into $1,365. And I would call that a phenomenal upside. But it is a directional biased strategy. So yeah, a lot of stuff. We're going to end the video right there because let's face it, 20 minutes of me talking about buying calls. I mean, we haven't even gotten into writing calls, buying or selling puts or any of that stuff. So, I mean, we got a long time to go. So we'll split these videos up, try to keep them within 20 minutes or so, and then we'll move on from there. There is a link in the description below if you do want to sign up for Tastyworks. But let me be clear, if you use the link, everything like that, you need a minimum deposit of $2,000 in order to have enough margin to be able to sell call options or put options, right? Just to be able to sell options. And you need that in the future because a lot of the strategies that we use in options require selling a call and then buying another call or whatnot. You know what I mean? So yeah, you're gonna have to get a pretty good handle on this stuff, and I don't want to just blow your brains out with an hour of just boring stuff. So we'll wrap it up there. Use the link in the description for Tastyworks. Minimum 2K. I went ahead and did 5K so that way I'd have a little bit more margin. And yeah, we're gonna start doing this. This is for my US peeps that no longer can trade Bitcoin futures. That's simply what we're gonna do. So I'll show you a way to make, just as much money, if not more, by using US markets. Thank you all for your time. Make sure you guys trade safe. Make sure you trade smart. And as always, happy trading, everybody.